Hello, everyone, and welcome to the Buck Stops Here. I am Catherine Murray. Well, we have certainly seen such incredible volatile markets lately. There's so much to digest and unravel in terms of what happens next. I am so thrilled to bring in the guest for you today, Gary Shilling. He is the president of Gary Shilling and Co., a famed economist and so well known and well respected on Wall Street and around the world. Gary, thank you so much for being with us and sharing your views today. There's so much to discuss.
Oh, delighted to be with you, Catherine.
Thank you. I want to first start with your views in terms of understanding the Ukraine Russia situation and how you see that impacting the economic outlook. And I want everybody to understand we are filming this on Friday, March the 11th, and this airs on the 13th, Sunday morning. So there's a lot of moving pieces and parts that can happen between now and then. But Gary, how do you see it today?
Oh, Russia is a small economy. It's only 7% of the U.S. Economy, and Russian GDP, $10,000 per capita versus 63,000 U.S. It's a small economy, but because it is a dictatorship, they're able to concentrate the resources. And of course, when you have a dictatorship, there isn't a lot of public dissent. Unless you want to go to the Gulag in Siberia. So it does give the Russians a lot more power than their economic size. We saw that during the Cold War when they really were matched off pretty well with the West, and now here. So you can't discount that. But at the same time, of course, you do have the question of the sanctions and so on and so forth. But again, I think you have to be a little careful because the Russians, they're used to tough times. I mean, you look back historically, they've never enjoyed the standard of living and the open opportunities that we have in the West. So I think to discount this and say that these sanctions are gonna bring Russia to its knees are vastly overdone. That doesn't mean that they can run roughshod over Ukraine. But bear in mind that what Putin is trying to do is to reestablish the Russian Empire. He's trying to reassemble the Soviet Union, if you will. And of course, as he uses the excuse of Ukraine, there are some Russians in eastern Ukraine. They're left over there from earlier times, the Soviet. But it's very much like Hitler's invasion of the Sudetenland in 1938. There were Germans in what then became part of Czechoslovakia after the collapse of the Austrian Empire. So you have these ethnic groups, and it's very different than in the U.S. or Canada, where people come to Canada to be Canadians, they come to the U.S. to be Americans. It's a different kind of situation. So it is a difficult situation, but I think in terms of economic effects, and that's what's important. It is going to be disruptive. It is adding more to inflation. It is making it tougher for central banks who are in the process of tightening, and they have a real dilemma. Are they going to tighten and risk a recession, which is the odds-on favorite? The Fed in the last 12 times that they've tightened credit, 11 of the 12 have got a recession. So that's an odds-on deal. But of course, if they back off, then they risk inflationary expectations where people anticipate prices, they buy ahead, and they get a inflationary spiral. So the Fed's between a rock and a hard place.
Yeah, and definitely. And, do you think, though, that the U.S. Federal Reserve, I mean, I don't know that there's really even a consensus out there right now. Do you think that the Fed is going to raise rates 5 times this year? I think that is the consensus number. Are they even going to be able to do that?
I really don't know. I mean, they've certainly backed away from this 50 basis point rise at a time. But Chairman Powell has made it very clear that he's open to that. He's made it clear that they're going to do it 25 basis points at a time, and their meetings are every six weeks. But as far as where they go, I think these guys are very much dependent on what's happening in the economy. I think the economy in the U.S. is very close to a recession anyway, and so the Fed may be very reluctant whether they go through raises every time or whether they hold off remains to be seen.
We're going to take a quick break, but when we come back, I want to pick up on why you see that we are close to a recession in the United States, because there's others who say absolutely not. We'll be right back. Gary, let's pick up on that recession conversation because and you write, and so interesting and so true. You don't become very popular on Wall Street as a strategist or economist if you're calling for a recession. You don't need to worry about that. But it isn't a popular move. Give us a little bit of granularity in terms of what you see going on underneath the surface in the U.S. economy.
The economy, even before the Russian invasion of Ukraine, was headed down. I think there are a couple of things. One is we had a housing boom here, low interest rates, people running to the suburbs to get bigger houses during the pandemic, and also the stimulus money that people got from the government back in 2020 and 2021. Those are big drivers, but that's all over. And house prices have gotten to the point that a lot of people simply can't afford it. So I think housing is going to weaken. Now, I don't think it's going to be a collapse like we had with the subprime mortgage disaster in 2008, but it is a weakening force. Another one is inventories. There's been a lot more inventory building than most people realize. If you look at one indicator, is all these ships that are sitting off of the ports in California. There were over 100 of them a couple of weeks ago. Now they're 48. They're unloading. Those goods are arriving. And actually, if you look at it, in the third quarter of last year, real GDP rose 2.2% at annual rates, but inventories accounted for 2.1 of that. In the fourth quarter, it rose 7%, but 4.6 percentage points of that were inventories. And you get a reversal of this. So that's another weakening factor. So you had these factors going in. Now you've got the Fed raising rates. I mentioned earlier, we look back at this into the early 50s, and every time the Fed raises rates, and we're looking at the Fed funds rate, their policy rate, every time they've done that, with one exception, in the early 90s, a recession is followed. So that's the odds-on bet by far. And of course, another factor here to look at is the yield curve. You look at the difference between the yield on 10-year Treasury notes and 2-year Treasury notes. It's not quite inverted with the shorter rates above the long-term rates, but it's very, very close. It's gone from about 100 basis points to 25 basis points since the end of the year. And when it inverts, again, that's a pretty sure sign of a recession. So you not only have the fundamental factors, but you've got the evidence in markets that I think push that way. Another thing, if you look at stocks, stocks are off their peak, and that's bear markets precede recessions. They start before the recession, and the breadth. If you look at the breadth, the advanced declines. You look at the concentration of stocks into a very narrower and narrower group. All those factors are very reminiscent of pre-recession times.
And Gary, can you just explain to all of our viewers why, when a central bank, whether it's the BOC, Bank of Canada, or the U.S. Federal Reserve raises rates, why that causes a recession? Because what the narrative in the news today, of course, is that they need to raise rates because there's so much inflation. And I wonder as well with the inflation, I mean, that's really, what I'm seeing is driven by the price of energy and gas. And of course, food is also moving higher. Why even? I mean, this is the basis of economics, and you're a famous economist. Why is raising rates the right move to even do when we are talking about that potentially or very frequently causing a recession?
Well, that's a good question, because the Fed typically worries about excess demand, and raising rates chokes off demand. People simply can't afford to borrow and spend. You've had some of that, but it's also been a big problem of lack of supply. So it is a much more complex issue than normal. But you look at other factors. I mean, for example, with this inflation, real wages, nominal wages, hey, they've risen year over year in this country about 7%. But if you if you subtract inflation, they're actually down a couple of percentage points. So there are a lot of these other factors. So the Fed raising rates per se is not the only thing, but it does indicate a tightening of credit, and at a time when I think the economy is already slipping.
So it doesn't seem like it's the right move to do.
Oh, but again, the Fed. What else can they do? I mean, it's the pushing on a string. They can they can tighten by pulling on the string, but you can't push on it. You can't really increase demand by pushing on the string.
So, Gary, you see a recession likely happening, correct?
Yes. Yes.
Okay. And how should viewers and investors think about that? Because I think what is on everybody's mind right now is not even a recession. Everybody's just looking at inflation and the gas prices and the food prices that they're paying. How should people be thinking about the world that we live in right now?
I think they ought to be exercising a lot of caution. I mean, obviously, people are when you look at the spirit of inflation, which is outrunning wages, other forms of income. Obviously, it puts the pressure on people's ability to spend. And I think that right now we are looking at a burst of inflation. Now, long term, as you know, Catherine, I've been very much a disinflationist actually since the early 80s. But I think we do have a temporary bulge in inflation, and it is very disruptive. So one thing that people need to do is to expect this to last at least a few more months. And I think it forces people to be cautious in terms of their spending because they can't expect their incomes to outrun inflation. Another thing as far as investors are concerned, I think you exercise extreme caution. You've got a lot of volatility in markets. What do you see happening? Well, one of the things that's happening is that there's a rush for the U.S. dollar as a safe haven. And that is, I think, being enhanced by the Russian invasion of Ukraine. You also have vulnerability in stocks. We manage money, and we are short stocks. We do it on a macro basis, the S&P 500. But if anybody wants to hold stocks, I think they ought to do what are called defensive stocks, things like utilities, consumer staples, things that people are going to buy pretty much regardless. But it's not a time to be adventuresome. And one of the areas I think is extremely vulnerable. Two of them. One are all the speculative areas, the SPICs, the GameStops of the world, the cryptocurrencies, and so on. You've had huge speculation in that area, and another area are companies without earnings or earnings in the distant future. And I'm talking here about not only small stocks but major growth stocks, because one theory is that their present prices are the discounted value. In other words, you discount their future earnings using at a current interest rates. Well, the higher the interest rates, the less those discounted earnings are worth, and hence the lower the current price. And we've already seen sell-off in a lot of these stocks with no earnings, and even with some of the big tech stocks. So I think they certainly ought to be avoided if people don't want to even sell them short.
Mm-hmm. And then what about going long? Like obviously energy's been, it was so unloved and forgotten for so many years. And now it's been an amazing place to be in terms of an investment vehicle or investment area sector to be involved in. How do you see that playing out?
Energy sector obviously has been on a wild tear. And the issue there is that Russia is an energy exporter. Now, we only have, I think 6% of our energy is imported from Russia, but that's not the point. It's much higher in Europe. I think something like 30-40% of their natural gas comes from Russia. And these are markets which are economists would say they're inelastic. It doesn't take much in the way of demand constriction in this case to increase prices. Now, does that mean that energy is at its peak? It very well may be, because there are other sources of energy But in terms of any big replacement of Russian energy, this takes years. The Biden administration has really gone for green energy. They have not allowed drilling. Frackers are not really convinced that they can tool up again. And liquefied natural gas to get the ships built, the terminals, and so on. This is a number of years to replace that Russian gas. So I think that in the meanwhile, we're probably looking at high energy prices. This is probably already reflected in stocks. I'm not sure you've got great investment opportunities there, but from a consumption standpoint, boy, I think you're going to continue to have to worry when you pull up to fill your gas tank.
Right. And of course, all the companies and corporations that rely still, of course, they do on fossil fuels and in all the areas in the market that actually translates into higher prices being passed on for sure. We'll take a quick break. We'll be right back with Gary Shilling. Gary, you called the biggest bond market rally historically going back to 1980, 81. And, that was, I guess, the best asset class to be in terms of returns. And where do you stand now in terms of the bond market rally?
Well, I call that the bond rally of a lifetime back then, as you may be aware. And since then, if you look at the total performance of long-term Treasury bonds, they've outperformed the S&P 500 by 5.5 times over that intervening 40 years. Now, the question is this over? I don't think so, because yes, we do have this problem right now with the burst of energy, with the supply chain disruptions, with reopening frictions because of the pandemic, and now, of course, added to that, the energy issues with the Russian invasion of Ukraine. But one of the things to keep in mind, which I think is very, very important, is that we are in an excess supply world. When you've got more supply than demand, what's it do to prices? It pushes them down. Now, why is that? Because you've got something out there called Asia. The Asians are huge producers, but they are very frugal spenders. If you look, for example, at China's consumer spending as a percentage of GDP, their total economy, is 38%. The U.S. is 68%, about almost twice as much. In other words, they produce, they don't spend. And it's the same in Vietnam and all these other countries where a lot of production is shifting out of China. And as long as that situation exists, you have a very strong deflationary forces. So I think that's a strong reason to say that this bond rally of a lifetime isn't over. Now, how far could it go? Well, if we go back to and these are just numbers, of course, but if we go back to the lows in yields, in long-term Treasury bond yields that we saw back at the beginning of the pandemic, and this was early 2020, you could see a 30% increase in the price, in the value of long-term Treasury bonds from here. And I think that over the next few years, that's probably going to be a lot better bet than equities, because I think equities are way overpriced. You look at equities in terms of this cyclically adjusted price earnings ratio would take a 55% decline in prices and the S&P 500 to bring it back to its long-term average.
55%, Gary? That's a huge drop.
It is. And bear markets overdo on the downside, just like bull markets do on the upside. So it is again, anybody who has a longer term time horizon, I think would be a lot better off in Treasury bonds than stocks. Now that doesn't mean you go whole hog, because right now we got the Fed raising rates, and it could have this temporary suspension in the bond rally of a lifetime, as I've called it.
Right. To be clear, in other words, you don't necessarily need to go long Treasury bonds right now. Wait it out perhaps a little bit.
Portfolios we manage. I mean, we still have a position in long-term treasuries, but it's actually about half of what we had earlier. So we're just exercising a certain amount of caution.
Okay. And Gary, my program is called The Buck Stops Here. So I like to hear from you and guess what your kind of one liner and messages to our viewers to take away from our conversation today.
I think it's caution. It's caution. We're in a world. Let's just look at the fact what's going on here. One is we have temporary inflationary pressures, supply chain disruptions, reopening after the pandemic, and now the Russian invasion of Ukraine. So you've got a temporary bulge of inflation. Two, you got evidence that the economy in the U.S. and I think it's even more true in Europe, by the way, that the economy is slipping. So that's a need for caution. Third, you got the Fed raising interest rates, and boy, the odds-on favorite by far there that we're going to get a recession. Yield curve is about ready to invert. And finally, there's a lot of pressure on people's real spending power with this temporary burst of inflation. So I think all these suggest caution, not only in portfolios, but also in terms of people's spending habits.
Okay. We will leave it there. Gary, great to see you. Thank you.
My pleasure. Good to be with you.